Level 1, the analyst, 23 years old, $100,000 base, zero bonus, and the silence will break you before the work does. There is no training program. That's the first thing that separates a hedge fund from everything you've done before. At Goldman, there were 6 weeks of onboarding, presentations, cohort dinners, a sense that the institution was investing in you before you invested in it. At a hedge fund, there is a desk, a Bloomberg terminal, and an unspoken expectation that you already know how to use both. You came from Goldman or Citadel or a top EVA program. You took a pay cut to be here. Base is $100,000, less than what you were making in banking. The bonus your first year will be zero because first-year analysts don't generate alpha, they generate research. Research is raw material. Raw material doesn't get a performance fee attached. The fund has 11 people managing $4.2 billion. Let that ratio sit for a moment. Your previous employer had 45,000 employees. The fund next door has 11 desks, 11 Bloomberg terminals, and a shared Google Doc where every position is tracked in real time. The ratio of assets to humans is so extreme that it feels like a category error, like discovering that 11 people are quietly responsible for the structural integrity of a city. The silence is the first thing that breaks people. Not the hours, the silence. No open trading floor, no analyst class to commiserate with, no ambient noise of institutional bureaucracy to absorb the pressure, just the hum of cooling systems and the occasional sound of someone typing, and the very specific quiet of people thinking about very large numbers. Your job is deceptively simple. Read everything about a company, annual reports, earnings transcripts, SEC filings, competitor analysis, channel checks, industry surveys, and then answer one question in a 2-page memo. Should we own this stock or not? You spend 3 weeks on your first memo. The PM reads it in 4 minutes. He says one word, pass. No explanation, no feedback, just pass, the way a surgeon might decline a tool without explaining the surgical logic to the person handing it over. You write a second memo. He says, interesting. You find out 3 months later that interesting is the best thing he has said to anyone in the office in over 6 months. A single word of qualified approval from a PM is the hedge fund equivalent of a standing ovation. You go back to your desk, you write another memo. Here's the thing nobody tells you about this level. You are not learning how to pick stocks. You are learning how to think, how to construct an argument that survives contact with someone who has been stress testing arguments for 20 years. The PM isn't reading your memo to find good stock ideas. He's reading it to find holes. Every question he asks that you can't answer is a hole. Every assumption you made that you can't defend is a hole. The job at this level is to make fewer holes each time. Most people quit within 18 months, not because the work is too hard, because the feedback loop is too brutal and too impersonal. The market doesn't care about your effort. Your PM doesn't soften the message. In 2023, during the rate spike that crushed growth equities, 3 analysts at multi-manager funds in New York quietly left finance entirely. They didn't go to private equity or corporate strategy, they left. That's how specific the psychological toll is. The ones who stay learn something that sounds simple and isn't. Being wrong quickly is more valuable than being right slowly. The market will teach you this. It always does. Level 2, the senior analyst, 26 years old, $350,000 total comp. You know one sector better than the people running it. You have a sector now. Consumer retail or healthcare or semiconductors, whatever it is yours completely. You track 40 stocks. You know every earnings call by heart. Not the headlines, the nuance. You know which CFO hedges his guidance by 8% every quarter because he's terrified of missing, and which one gives you the number he actually believes because he's been right 11 quarters in a row and wants you to know it. You know which management teams are empire builders, spending shareholder capital on acquisitions that serve their ego, and which ones are operators who run lean and eat what they kill. This knowledge took 3 years to build. It cannot be downloaded. It cannot be accelerated. A competitor analyst at a large mutual fund covers the same sector but covers 200 stocks. You cover 40. The depth differential is not 5x. It's closer to 50x. When something moves in your sector, you know why before the press release hits. Total comp last year, $350,000. Base $150,000, bonus $200,000. The bonus sounds large. It is large, and it also arrived in February, which means you lived on $150,000 for 14 months while doing the work that generated the bonus, which is the hedge fund industry's charming approach to compensation timing. Your first real call, a specialty retailer that the market has completely written off after 2 bad quarters, down 42% from its high. Every sell-side analyst has downgraded it. The narrative is consensus. Management is broken, the category is dying, e-commerce has won. You spend 6 weeks inside this company. You talk to former employees, to suppliers, to mall operators, to the new CEO's previous CFO at his last job. You build a unit economics model that goes back 8 years. Your conclusion, the market is wrong. The write-downs were one time. The unit economics at the store level are actually fine. The new CEO has done this exact turnaround 2 times before, and both times the stock tripled. The consensus narrative is a story the market told itself after a bad quarter, and nobody has bothered to update it with new information. You present to the PM. 20 minutes. He asks 14 questions. You answer 13 perfectly. He sizes it at 2% of the book, $84 million. The stock goes up 34% in 4 months. The PM nods at you in the hallway. That's the celebration. A nod. No dinner, no announcement. You go back to your desk and start on the next one. This is the specific cruelty and the specific beauty of this job. There is no finish line. There is only the next position. The $84 million win disappears into the portfolio attribution report and becomes the baseline expectation for next quarter. You are only as good as what you are working on right now. The portfolio attribution report runs every morning at 7 a.m. Every single day, the market grades your work and posts the result on a shared screen that everyone in the office can see. You are never not being evaluated. At Goldman, nobody could tell on a Tuesday whether you were having a good quarter. Here, everybody can tell by 7:04 a.m. Level 3, the portfolio manager, 30 years old, $300 million to run, and you lose $18 million on a Tuesday and feel nothing. You run a book now, $300 million, not the fund's money in an abstract sense, your capital allocation, your positions, your P&L hitting the shared screen every morning with your name attached. Nobody manages you anymore. Nobody tells you what to buy. Nobody reviews your memos before you act on them. You are the decision. Every morning the market opens and your positions move, and every movement is a verdict on your thinking rendered in real time by the combined intelligence of every other participant in the market. You lose $18 million in a single afternoon when a position gaps down 22% on unexpected earnings, a company you'd been long for 8 months, where you'd done the work, where your thesis was right about the fundamentals and wrong about the timing because the CFO pulled forward expenses in a way that was completely legal and completely impossible to model from the outside. Your stomach doesn't drop. That stopped happening around month 6. Now it's a number, a wrong number that needs to be addressed. You cut the position, you take the loss, you write up why you were wrong, not for your PM, not for the risk committee, for yourself, in a Google Doc that nobody else reads. Because the only way to survive this job long term is to be ruthlessly honest about your mistakes before the market makes the honesty mandatory. Here's a statistic that sounds alarming until you understand it. The best PMs in the world are right about 54% of the time, slightly more than a coin flip. In 2024, a study of 5,000 institutional equity positions found that even top decile managers had win rates below 60%. What separates exceptional from average isn't being right more often, it's being right bigger when you're right and wrong smaller when you're wrong. Position sizing is the actual skill. The stock picking is just the raw material. The pressure at this level is nothing like banking pressure. Banking pressure is about deadlines and clients and hierarchical approval chains. This pressure is statistical and permanent and completely indifferent to your personal circumstances. The market opened this morning while you were at your daughter's pediatrician appointment. Your positions moved while you were sitting in a waiting room with cartoon animals on the wall. The attribution report doesn't pause for pediatricians. Level 4, the senior portfolio manager, 34 years old, $900 million, 2 analysts who remind you of your worst habits. The fund gave you more capital because you earned it, $900 million now, nearly $1 billion that moves when you decide it moves. Total comp last year, $2.8 million. You have a house, a good one. You have a family. You see them on weekends when there isn't a position blowing up. There is always a position blowing up. You have 2 junior analysts now. They remind you of yourself at 23 in ways that are occasionally charming and mostly alarming. The hunger is the same. The certainty is the same. That specific certainty of someone who has been right enough times to forget how many times they've been wrong. You remember that certainty felt like. You remember the exact position that broke it. You do not give them comfort. Comfort makes analysts soft. Soft analysts lose money. You give them feedback that is precise and impersonal and occasionally devastating, the same way the market gave it to you. Here's the danger at this level that nobody explains until you watch it happen. Complete autonomy is the most dangerous thing that can happen to a PM's career. When nobody is watching, discipline is the only thing between you and a catastrophic drawdown, and discipline, it turns out, is much easier to maintain when someone is watching. In 2022 and 2023, a wave of high-profile PM blowups across Tiger Global, Melvin Capital, and several multi-manager platforms shared a common thread: Not bad stock picking, but position sizing discipline that evaporated when the fund was performing well. They sized up too aggressively, they held losers too long, they started believing the money meant they were smart rather than understanding the money meant they'd been right so far. The two PMs are different things. Being right so far is survivable, believing you're smart is fatal. You tell yourself this every morning, not as a mantra, as a warning. Level 5, the partner, 38 years old, equity in the machine, and the bad years cost you your savings. You have equity now, not just your book, a percentage of the fund itself, the whole machine. This changes the psychology completely in a way that takes about 6 months to fully land. You no longer optimize for your book's performance, you optimize for the fund's survival and growth. These are related objectives that occasionally conflict, and navigating the conflict is the actual job of being a partner. The fund made $380 million last year. Your cut, $4.1 million. The year before, the fund lost money. Your cut, $0. You have a mortgage sized around the good years. The bad years are a problem you solve by not thinking about them until you have to. Here's the part that doesn't appear in the job description. You have $6 million of your own money in the fund. Partners eat their own cooking. This is called alignment of incentives. It is also called the mechanism by which a bad year doesn't just cost you your bonus, it costs you your savings. The market doesn't care that you're a partner. It never did. Every title at this level is provisional. Every reputation is one bad year from complete revision. The hedge fund industry is currently experiencing its most significant structural pressure in a decade. Fee compression, historically 2 and 20, now trending toward 1.5 and 15 for most funds, combined with the sustained outperformance of passive index funds, has forced limited partners to ask increasingly hard questions about what they're actually paying for. In 2024, hedge fund liquidations outpaced new fund launches for the third consecutive year. The capital is concentrating in fewer, larger funds, the middle tiers getting squeezed out of existence. You think about this sometimes, not often. The position in front of you is more urgent than the industry structure behind you, but sometimes late, when the terminal is still open and the office is empty, you think about it. Level 6, the CIO. 43 years old, $8.7 billion, and you sleep 4 hours a night because your brain won't stop running. You are the strategy now. Every position in the fund reflects your thinking, every return, every loss. The fund manages $8.7 billion. When you are wrong, $8.7 billion is wrong with you. There is no committee to absorb the decision, no hierarchy to dilute the blame. You are the first name on every result and the last line of defense against every mistake. You sleep 4 hours a night, not because you're still working, because your brain won't stop running scenarios. Position sizing across the book, correlation between holdings that looked uncorrelated until a liquidity event made everything correlated simultaneously. The macro risk you've hedged versus the macro risk you think is too expensive to hedge. The thing you haven't thought of yet that is going to cost you. That last one never stops. The unknown unknown is the one that actually kills funds. Here's something the performance reports don't capture. Adding a position to an $8.7 billion portfolio isn't addition, it's a chemical reaction. Every new position changes the risk profile of every existing one. A new long in semiconductors increases your exposure to Taiwan Strait geopolitical risk across positions you didn't think were exposed. A short in retail affects your correlation to consumer discretionary in ways that your existing consumer positions now amplify. You have to model what happens to the entire portfolio before you touch a single position. This is why good CIOs reject 90% of the ideas their analysts bring them, not because the ideas are bad, because the portfolio is a system, and most good ideas are bad system additions. Twice a year, the investors fly in. Pension funds from Ohio and California, university endowments, sovereign wealth funds from the Gulf. They manage money for teachers, for retirees, for national reserves. They are polite and intelligent, and they will pull their capital without hesitation if your Sharpe ratio slips for 2 consecutive quarters. You spend 2 days being precise and charming and completely transparent about everything except the positions, which you can never fully disclose because the positions are the only thing that is actually proprietary. You go home exhausted. You open the terminal. You check the positions. You start again. Level 7. The founder. 47 years old. Your name is on the door. That was the first mistake. You left. That's how every founder's story starts. You left because you were right too often to keep sharing the upside with someone else's fund. 3 investors believed in your track record. $200 million to start. That was 6 years ago. The fund is $3.1 billion now. You built that number from zero. Your name is literally on the door. The fund is named after you. And that was the first mistake you made as a founder, because when the fund is named after you, every loss is personal. Every redemption letter is a verdict. Every quarter that underperforms is a public statement about your judgment published in the language of returns. You are not running a fund anymore. You are managing a reputation that happens to have a portfolio attached. You have 23 employees. Their mortgages, their bonuses, their children's school fees, their professional identities, all of it runs through your performance. You think about this when a position moves against you. You never thought about it at the analyst level. At the analyst level, you thought about being right at scale, consistently, in every market condition with other people's lives attached to the outcome. That is an entirely different cognitive and emotional experience than being right on a memo that a PM reads in 4 minutes. The hedge fund industry in 2025 has a specific new pressure that didn't exist a decade ago. The rise of multi-manager platforms, Millennium, Citadel, Point72, has created a talent war that is actively pulling your best analysts away with guaranteed compensation packages that your performance-based model structurally cannot match in a bad year. You've lost 2 senior analysts in 18 months to pod shops offering guaranteed 7-figure packages. The irony is perfect. The model that made you successful creates a retention problem at the exact moment you need stability most. You haven't taken a real vacation in 4 years. Not 4 days, 4 years. You've been to places that looked like vacations from the outside. Hotels with pools, different time zones, your phone in your pocket with positions that moved while you were pretending to be somewhere else. Closing. The machine. The fund doesn't stop when you burn out. It finds someone younger who hasn't burned out yet. Someone who hasn't learned yet what certainty costs at scale. Someone for whom the silence is still interesting rather than oppressive. Right now, at a bank in Midtown Manhattan, a senior analyst is sitting across from a headhunter. The headhunter is describing a fund. Small team, high performance culture, exceptional upside. The analyst is doing the math. The math makes sense. The math always makes sense at the beginning. He's going to take it. Of course he is. He's 26 and the numbers work, and nobody has told him yet about the 7 a.m. attribution report. Nobody has told him about the 4-hour nights. Nobody has told him that the best PMs in the world are right 54% of the time, and the other 46% is where the actual education happens. He'll be good, maybe exceptional, possibly the best in his generation at this specific, brutal, beautiful discipline of being right about companies before the market agrees with you. The market will teach him the rest. It always does, and it never stops charging tuition.